Hello and welcome to another technical analysis tutorial. And today in this video, I want to talk about the moving average or simple moving average and the exponential moving average. Which one is actually better and what's the difference? So we're going to take a look at that. Before we start, a few things about moving averages in general. And I mean, there are these two types, simple moving average and exponential moving average. So basically, what you need to stop doing, in my opinion, that's what I found, is to stop looking for the perfect moving average. There is not one perfect moving average. There is not one perfect time frame. And essentially, what I've learned is the best for me is to use one moving average or two and just stick with it, because switching around all the time doesn't really help you with making consistent trading decisions, for example, or with doing technical analysis properly. So try to bring some consistency in, try to stick with one. If it doesn't work for you, then try another one, and maybe you will settle for one or two or maybe a maximum three moving averages that work for you in your particular market. I mean, I currently have a cryptocurrency open here, Cardano, but there are so many different markets. I mean, moving averages and exponential moving averages work in all markets, in all time frames, but essentially you need to work out what works for your own strategy. And later we'll talk about one that I recommend for beginners. So if you want to learn more about that, stay tuned. What I've got open here is a chart with a 100-day moving average and a 100-day exponential moving average. Essentially, the difference between both of them is that the exponential moving average works a little bit faster. It moves up and down a little bit more. It's a little bit more volatile. It just reacts a bit faster to the price change. So essentially, there is no good or bad. There is no right or wrong here. What we will see in a minute is that sometimes the simple moving average works better and sometimes the exponential moving average works better. But it's hard to then, pick the one that really works best for you. Just stick with one and try if it works for you. But there is not one best or perfect moving average. The second thing that you need to know is that there are different periods. So you can have, for example, the 9-period moving average, the 10-period moving average, the 20, the 50, the 100, and the 200. I think these are like the main ones. So talking about the lower numbers, maybe from 9 to 20, that helps really with quick decision making. The medium period moving average, like the 50, for example, that is like the medium trend. I use that very often. It's like combining the best of both worlds. And then you have the 100 and 200 period moving averages, and they are really for the long-term direction to understand, are we actually in an uptrend or a downtrend from a longer term point of view. But now, again, let's take a look here at this 100 period moving average chart. Well, with both the simple and the exponential moving average here on the daily chart. And what you can see, sometimes you've got the simple moving average closer to the to the price action, and sometimes you have the exponential moving average closer to the price action. So if we take a look at this area here where we had a support, where I think the moving average acted as support sort of, we had, for example, the exponential moving average just a little bit more closer to the moving average. Here it was the simple moving average, which was a bit closer to the lower end of the candle. Here again the simple moving average, here again the simple moving average, and here again the simple moving average. So and again here the simple moving average. Generally in crypto markets, because I'm in crypto a lot, I prefer the simple moving average because it reacts quicker. The exponential moving average reacts quicker, and because crypto is quite volatile already, I recommend, I found that for me the simple moving average works a bit better. Otherwise, you have less stability, I think. So what you could also do is just picking, for example, if you find the 100 doesn't work for you, then you could try the 50. And I recommend you stick with just the main numbers that I just told you, like the 9, the 10, the 20, 50, 100, or 200. Because if you just try to reinvent something or invent something new that nobody else uses, then it won't really help you. Because this is all about self-fulfilling prophecy. So these only work because many people are using them. And again, what we can see here is that here the 50-day moving average, the simple moving average, worked really well. All the time here it worked really well. I think the exponential is maybe in crypto not the best the best pick. Here again, the simple moving average. Here again, both, I think. Here it might have been the exponential moving average. Whoops, over here I think it's both, where you had a crossover here anyway. But yeah, I mean, it's about experimenting a little bit with the different time frames and choosing which one works well for you. One way of doing or really using them is, for example, if you're doing trading, for example, you could use the 4-hour chart. And what you can then do, for example, and let's just take the exponential moving average out, because the difference is quite minor. And for example, I got used to using the simple moving average. Again, there might be situations in markets where the exponential moving average works a bit better, but I found over the years that for me, the simple moving average just works better. But maybe that just works with my personal trading strategy. So if you find the exponential one works better for you, use it. But in the end, I think there is no real advantage or disadvantage. It's just that the exponential moving average works a bit faster, reacts a little bit quicker, but then I think the difference is minor. And again, as I said, there is no right or wrong here. So let me just add another simple moving average. I just want to show you a way of how you can use the moving average in trading or in technical analysis. So let's pick, for example, the 50. That's where I say, as a beginner, maybe start with a 50. Maybe start with a 50 and see how it's going. Maybe you want to start with something that I'm going to show you now. So what you can do when you add two moving averages, two 50-period moving averages to your chart, you can set one to the daily time frame. So let's just do that. So what you'll then have, for example, if you look into a shorter term time frame like the 4-hour one, but you still want to understand, are you in an uptrend, for example? And generally, by the way, moving averages, I only recommend to use them in trending markets. If you're in a range market or a sideways move market, they generally don't work because they are crossed by the price very often, and I don't recommend using them. In range markets, the price generally very hardly respects the moving averages, but in a trending market like here in an uptrend, they work really well. So what we have essentially here now is you've got two moving averages. One is the blue one is the 50-period moving average on the 4-hour based on the 4-hour time frame, and the green one here is the 50-day moving average as well, but based on the next higher time frame, or not the next higher, but on the daily time frame. So what we can see, you can then use, for example, the 50-day from the daily to understand if we are, from a longer term point of view, in an up or a downtrend. And if we are, and then you've got the 50-day moving average to help you with making trading decisions, for example. So for example, what we can see here very, very nicely is from here where we had this crossover on the 4th of August. From here, we actually have been both in a uptrend based on the daily time frame 50-day moving average, and also based on the 50-day moving on the 50-period moving average on the 4-hour chart. And this is how you can use them both. For example, here the blue line, the 4-hour 50-period moving average, you can see that it actually acts as support quite often, right? So it's a good indicator to enter some long trades, for example. So here, whenever, for example, actually from down here, so whenever the price actually touched this blue line, it really acted as support, and you could have entered a long trade. And then when you saw the momentum going down, you could have realized your profits and then re-entered here when it touched again the moving average. So that's how you can use it. And again, then you can use the longer term time frame to understand, are you actually in an uptrend or a downtrend? Because what could happen is that down here, you actually had already this blue line acting as support, but you were technically still in a downtrend because the green line here, the daily, was actually going down. So here I would have been more careful to enter a long position. But then from here, where we really also from a daily point of view were in an uptrending market, I would have been more active in entering long positions, because if you use this strategy, I personally use it only together with the trend. So I wouldn't go into a long position necessarily if we are in a downtrend like we were here. Yeah, wouldn't do it really. Even if we, for example, here, you can use that it acted as support here. Yeah, but I wouldn't have gone into a long position here because we were in a downtrend from a higher time frame point of view. But here, hope that becomes clear, we were from a daily point of view in an uptrend, and also we had the 50 period moving average from the 4-hour time frame acting as support. So that is one strategy that a beginner can use. Again, you always need to come to your own conclusions. This is not financial advice in any way, but I think I found that worked pretty well. Again, here worked pretty well here in that period, in that uptrend. We were in an uptrend actually from here, and from here then you had this acting as support. You had actually the daily one acting as support, so you could have entered a long position here. Realized maybe up here when you figured out, oh, we are not making a new higher high, and then re-entered here when you had the 50, the blue line acting as support again, acting here again, you know, enter a long position, stay in the trend until we're losing momentum. I think you could have taken profits here, because that is when we failed to make a new higher high, and then you could have basically sold, and you figured out, oh, the blue line didn't realize, or didn't work as support again. So we were then actually in a downtrend, went above it again. The blue line acted as resistance. So it was a lot of up and down, probably a bit hard to trade this one. But yeah, this is how you can use it, guys. This is how you can use it. It's combining the daily, so the 50-day moving average, and from a shorter time frame point of view, the shorter time frame 50 period moving average as well, using one as support and resistance line and the other one to figure out, are you actually in an uptrend or a downtrend? And again, I always trade with the trends. I would not enter a long position in a long-term downtrend. Just wouldn't do it. Too much risk for me, and the reward is not big enough, because in a downtrend, entering a long position would mean that these would often be just consolidations from price reductions, and they are normally not that rewarding. So hopefully you liked that video. If you did, please smash the like button, and if you want to follow me on this technical analysis journey, then please subscribe. Thanks a lot for watching, and see you in the next video. Bye.